as I've written publicly, I had a CIO, a chief investment officer role over sustainable investing. I have spent my career as an investor. I first was an investment banker in the tech sector in Palo Alto, and then later as an investor of distressed and other asset classes. And to be honest, as I've written publicly, the CIO role for sustainable investing did not feel like a chief investment officer role in any way that I've understood one. In fact, it was more a marketing role than anything else. And what I say by that is reality is that, if there's ways for investment teams to make money off, specific data sets, thinking about climate change or other things, they almost always tend to think about that ahead of time, right? They don't need a centralized team to come in and ask them nicely to look at some data sets they've never looked at. To the extent that happens, when external teams come and pressure them, it's usually around risk or certain areas. But, in this case, it seemed like the tail wagging the dog a bit because, the impetus for us to put ESG into our policies was less because it truly had some alpha value or some particular risk mitigation that we could see. It seemed primarily that it was coming from pressure, at the top to be seen to be doing lots on ESG, alongside a broader narrative that sort of says that this creates real world impact, which I definitely did not see in any capacity. I think that the ideas of the space are that looking at ESG and climate considerations improves your investing, right? You get better returns, which you have to do because you're a fiduciary. Otherwise, you couldn't even look at the data set, or certainly you couldn't use it. And there's the idea is that it also makes the world a better place because it changes the behavior of companies. And fundamentally, I would say that in theory and practice, in theory, that doesn't make any sense. I would encourage people to look at Aswath Damodaran, is a New York professor of finance at NYU, who's written a lot about this recently, and points out that, the theory behind ESG doesn't even make any sense. He's actually quite adamant. It's completely sloppy, sort of stuff that we want to believe. And so people have sort of just lifted the pen and let it go. And I would tell you that everything I saw in practice, none of that was true. It was not particularly useful for returns, although we were incentivized to say that, right? Or, in some sense, there's a possibility of regulation of important areas. Often I think Wall Street has a strong incentive to claim that they're going to do it on their own, to keep away the chance of regulation. And a lot of my writings, I compare competitive markets to competitive sports. And I would liken this to saying that if the players realize that the game has gotten dirty and that eventually people are going to call in the refs to clean it up, and they don't want that to happen, they're likely to start saying that, talking about good sportsmanship and all the great things they're doing to clean up the game, and argue that, you would make the argument that you don't need to referee them because it's in their own interest to play clean. This is one thing that I saw, that it was not true that it was particularly useful for return, but there's a huge rush in the industry to say that that's the case. And I'd say that there's absolutely no evidence that it's doing anything good for the world, because again, for the most part, when you get into the mechanics of what's being done, they're usually things like ESG integration, which I mentioned, which are non-binding marketing promises to consider a data set, but there's by definition of fiduciary duty, you can't actually, forcibly comply with it. And, and the reality is that there's no evidence that any of those products actually move capital to green causes in any useful way that wouldn't have otherwise happened. Hence why I've gotten particularly worried that it's not only not helpful, it's what I call a dangerous placebo that harms the public interest, because if it doesn't have any impact, which I was the person who was integrating ESG and this climate stuff into the largest pool of assets available in capitalism today. And that was the reason I wanted to sound the alarm bell, because it just doesn't do anything that they say it does, and we're burning valuable time, putting hopes and prayers behind something that seems to serve Wall Street's interests more than it does the planet's.
Can you tell us a little bit more about that? Why is that so worrying, and what would you suggest to do?
So the biggest concern I have is that it's a placebo, right? I wouldn't say that green investing in and of itself is harmful, because it's hard to make the argument that like a green bond, introducing green bonds, for example, is better than not introducing green bonds, right? Like, arguably, that couldn't really be harmful. The problem is that most of these products just seem to move money around, and they do very little actually to promote more capital towards good causes. So to give you an example, I'll give you an example of ESG ETFs, right? ETFs and passive are the biggest area of sustainable investing and generally huge, and green bonds, which are also popular. With ESG ETFs, what they're effectively doing is saying, we're going to take some kind of a score, right? Usually some kind of ESG score from a third-party provider, and we're going to use that information to tilt a portfolio towards like some ESG version of an index. And what you find is that, number one, people, this is kind of crazy, is that ESG scores don't tell people what they think that they tell them. Bloomberg Business Week did a huge expose in December going through all the data and figuring out that like it's just measuring ESG risks rather than like your impact on the world. And so actually, like if Trump were to get reelected next year or in 2 years, ESG scores would actually go up. And the reason being that not because they're doing more for the world, random fossil fuel companies, it would be because their risks of being regulated around ESG issues actually have lowered because of the election of Trump. And so the ESG score goes up. There's a whole bunch of things where the public doesn't seem to really comprehend yet what actually these things mean. But in general, they'll have these scores. It'll tilt a bit of an existing index portfolio towards a little bit more ESG stuff, which generally has meant in the last few years, you'll overweight tech and underweight fossil fuels. So, more Microsoft and less Exxon. That led to a fallacy that ESG strategies perform better, particularly that boosted during the pandemic. And it was just a coincidence of obviously the pandemic meant that, we could not travel and we were forced to use technology. And so, of course, the tech stocks went up and fossil fuel companies went down, and oil even was momentarily trading at negative. And so we've seen that reverse in the last 6 to 12 months. And, those products, all they're really doing is taking secondary shares already traded in public markets, and passive product is a basket of low cost, shares that allow people, large firms, whatever, or individuals to track the index at a very low price. An ESG ETF is basically saying, I can take a basket and put a little bit more green in, a little bit less of the brown stuff, hand it to a socially conscious investor and see a fee bump, because ESG funds on average have slightly over 40% higher fees. Green bonds are similar, right? They're just taking existing things and siphoning off, sort of sometimes good causes, even though half the time they're not really good, it's hard to measure them. And even to the extent that they are, all it does is allow, you're socially responsible, so you might get the ESG version of it. And the hedge fund I used to work at earlier in my career, they'll happily own the fossil fuel shares that, you own less of. In the end, the market still clears. And the only difference is that, those packaging these products for the market can charge more for the green product, which is no different than going to the grocery store or the department store, and you have sort of, the green laundry detergent and the non-green version. There's usually no difference between them unless someone regulates what it is to be green. But there's a very strong impetus, whether you're selling detergent or clothes or investment funds, to give a paint a version of it green and charge higher in fees.
Would it help if you would separate it will be just non-fossil fuels will be separated from the other stuff, so it cannot just raise the score because they have technologies there, and
it could be, I think that you could build these products better. The fundamental concern I have is that ultimately it doesn't really create any real world change. It seems almost like it's intended to, if there's a bunch of shares in the market and they're all trading around, and some of these companies haven't raised money in years. Microsoft hasn't gone to the market since the 80s, right? So technically, it's not really affecting their financing cost. It matters to them, right? I mean, they give options and people are incentivized to shares, but, ultimately, most of the theory behind it is sort of falls apart when you actually look at sort of how the markets work. But I think, what you sort of see is just collecting of shares in different areas, and the market still clears in the end. And my concern is that even if you have a lot of, even if you built the products better, I don't think there's an answer where virtuous investors are going to, put more money in and create the impetus we need, because ultimately the market will clear and, someone else will buy the fossil fuel shares. I think that, the most important thing is really to remember that these are just externalities, right? We're talking about economic theory or at externalities. And I think ultimately, as long as something is legal and it makes money, I think it's actually, based on what I've seen in my career, it's very foolish to believe that, we can repackage products and then, people put money into good things. Because again, I worked in a corner of the market where I did distressed investing. We would buy anything that socially conscious investors would get rid of. We were looking for it, right? We were looking for anything that, and that's what distressed investors do. They're looking for outsized returns in corners of the market where other people are fleeing, whether it's ethical reasons, whether it's a market downturn of the type starting to see now. And so, ultimately, I think the most important thing is that, if you really want to see real world results, you have to actually internalize the externality. And if you do that, you don't need to worry about green funds, ESG funds, whatever. The market will do what the market's always done, which is find the most profitable investment opportunities. And I think if we look back at economic history, I would say that to take the US, for example, the US had better outcomes in terms of economic inequality and environmental protections in the post-World War II period. Richard Nixon founded the EPA in 1970, and yet you had no parallel financial system of premium priced green assets that purported to undo what the regular financial system was doing. It was just ultimately that the government, I would argue, did their job. And if you make, if you make brown industries less profitable and green industries more profitable, which is a simple, it's the economic theory from 100 years ago, you'll channel more capital faster to green causes. And so I think that is really the most important thing, because the challenge with a lot of the financial products is that ultimately they just allow you to attribute yourself less guilt. Because, I own less, the world has the same amount of emissions, but like now the socially conscious investors on paper own a bit less. The hedge funds, the market clears, the hedge funds take the other ones, same amount of emissions, but, good people get to, on paper have less, guilt. And I think fundamentally, that doesn't work anywhere, right? You can't invest in a public porn company, to my knowledge, right? And yet, it still exists. They're just private. We've seen in the last few years a massive trend where fossil fuel companies and Western companies that are under pressure for these things will just say, okay, well, we'll sell the assets to a private firm. They don't get any pressure on ESG or anything else. And so they operate them, just the way they always would.
So you're just saying that the government should do this? Who will actually act upon these externalities so the market will act differently?
It has to be governments. And I want to stress this, because when I've gone on CNBC and other places in the States, I'm Canadian, they'll sometimes, I've worked in the US, they'll always sort of say, oh, well, what about capitalism? And I'll say, what are you talking about? Like, I'm a capitalist, right? I started my career as an investment banker. I believe capitalism has rules, right? Like a competitive sport, there is no such thing as a free market. It's a fallacy. Saying it'd be a free market would be like saying you play a sport with no rules. That doesn't make any sense. Every competitive endeavor has rules. And right now there are rules of the market. If we were to change those rules, we'll get a different outcome. That's still a market outcome. But, there's often this sort of, really it's not intellectually correct at all. It's more of just sort of propaganda around a free market. And this approach that, it has these sacrosanct rules that can't be changed. In actual fact, I'll tell you, as a capitalist and a banker, it has to be the government. And everyone says that behind the scenes is that, like I had portfolio managers at BlackRock, they'd tell me, they said, listen, I believe in climate change, right? I want to do everything I can to help, but my, investment horizon is 6 months, and so we're looking at, senior debt securities for 6 months. They said, look, climate risks don't matter for that. They matter for the world, but that's fundamentally challenged. If your loan book is 5 years or, it's shrinking, you may not care about that, even if the world does, right? And even if you want to help, like you have a fiduciary duty, very strictly interpreted, to focus on value measured in dollar values, not social values, because of course it's someone else's money. And in that context, the only thing we can do to help them is the government actually, taxes pollution. And the same portfolio manager at BlackRock said, listen, if the government, put a price on carbon, I would lower my, exposure to emissions because it's going to cost now. And it's, as a fiduciary, I can actually reduce it because it's profit oriented. And so would every other, every single other portfolio manager, regardless of political affiliation or anything else. But we're not doing that. The challenge is that we're waiting for the free market to self-correct, which is fundamentally what scares me and why I started arguing publicly is ESG today and all of the associated arguments, whether it's the stuff around integrating climate risks into portfolios, which again is not stopping climate change. It's making sure that we're not exposed to the destruction of it. All of these things are just free market self-corrects theories, and they don't really tend to work. And, as we've seen in the last few years, they waste a lot of time because we see ESG words and ESG assets increasing, and they increase alongside emissions and all of the things they're in theory meant to do something about because there's no link between the two.
So who do you think can influence politicians to do that? Do you think investors, there's this game between investors and governments, and actually if investors will show that this is what they want, they don't want to be fooled, they don't want to fake, so would you think that would help for governments, for asset managers like BlackRock or others?
You mean if investors actually stood up and said, hey, this is what we need and this would be helpful?
Yeah.
100%. The biggest challenge today is not that BlackRock can solve the climate crisis, but they're not. It's actually different than that. It's that they can't solve it, and they're saying that they can. And so in reality, Larry Fink can't, wave a wand and start sending more money to green causes in the way that the world probably needs to sort of to address a funding gap, simply because he doesn't control the direct investment flows in the ways that we think. He'll have control over strategies that BlackRock builds and this and that, but ultimately those final investment decisions, the portfolio managers have autonomy. Because of that fiduciary obligation. And so Larry couldn't come in and say, hey, do more green stuff, because I've decided, we need to do our part for climate change. If the profit isn't there, they won't do it and they're legally prohibited. And indeed, Larry begins every one of his annual letters that have gotten a lot of fanfare in recent years that he writes at the beginning of the year. He almost always starts them by saying we're a fiduciary. It's almost as a disclaimer, and then says all these great things about green stuff. And so that's I would say the fundamental debate in the investment community is that I and a lot of other people, pretty much everybody behind the scenes, but it's difficult to say it publicly, believe that the incentives of the system are not built in a way that will give us the social outcomes that we want and claim a need from the system. And that is really at its core a question of externalities, particularly with the climate crisis. It's, I think it was a Stern review in the UK that wrote in 2006, they said it's the biggest market failure in history. Yeah. And it's 2022. And we have not internalized the externality, even though, in 2018, Bill Nordhaus won the Nobel Prize in Economics for talking about a price on carbon. This has all been known for decades. What's happening instead is this ESG fantasy. And I think, when you ask a question about what can investors do, I think that I think that's really fundamentally it. If investors said, we can't solve this problem because we have to focus on returns and the returns aren't there, it would a little be a bit like if we were all playing a sport and it was and it's a soccer game. And at some point the game got so dirty and people were fouling and the players said, listen, we have to focus on scoring. That's what we're here to do, right? Otherwise we get put on the bench. And it turns out the game is set up that we can score in ways that are dirty, right? We can get away with fouling and other things. That's an argument to call in the refs. In sports, you would do that. In business, I think that's fundamentally the debate because it is what needs to happen. But this is the big challenge. Why it's not happening is because most of the incentives in the space are very short term. So if every single CEO on Wall Street was getting paid based on the success of their net zero commitments, I can tell you that we would see a lot. First of all, it wouldn't be net zero 2050. It would be like in the next 5 years, for an important profit line, they wouldn't have a PR statement about, something they're planning to do 3 decades from now, right? This is the challenge is that today CEO pay is the highest it's been in decades, right? It's 320 times the average industry worker. CEO tenure is the shortest it's been in decades. It's the average is 5 years. This is all US data. in that context, the right thing to do for them would be to say, we can't fix this problem and the government needs to internalize the externality. The reality is, this is important for them to do that. They're going to personally take a hit in order for the public interest to be solved. Why? Because there's this fallacy saying, oh, if they don't do the right thing, we're all going to get burned by climate change. I mean, yes, but over a long enough period, and their incentives are this short, right? So if your incentives are very short, your incentives are not actually to fix the long-term problem. They're to market yourself and say that you're doing all these green things and lots of PR and green and stand on stages and whatever. But ultimately, it's to kick the can down the road, right? Because it's cheaper to market yourself as doing the right thing and being super green than to actually make those investments required, because they cost a lot of money in the near term and they may pay off in decades.